Hi, I'm Jamsi. I'm a finance professor and welcome to another video. So for today, we will be continuing our discussion on strategic business analysis. Last time, we talked about how strategic business analysis is done, who is the business analyst, and just some of the main reasons why we need to do strategic business analysis. After discussing all of those things, we dive into step one of the analysis process. And as dictated or as suggested in our previous module, it is accounting analysis that goes first. In part one of the accounting analysis lecture, we went through and recapped the different financial statements, the different features of financial reporting, and the main reasons why accounting quality could be affected by some of our accounting choices. So with that in mind, let's move forward with the steps in accounting analysis. So, as with any other process, we have to begin with step one. And in strategic business analysis, the analysis of accounting data is also the first step into the 360-degree examination of the firm. So it starts with the financial statements. With that in mind, what is the first step in analyzing the accounting data presented in the financial statements? Step one. Step one revolves around the identification of principal accounting policies. So in identifying principal accounting policies, we need to start asking, what are the business accounting policies, procedures, and estimates? Of course, we recognize that we have a lot of accounting policies, procedures, and estimates. How do we know if this is important? Of course, as analysts, we need to start brushing up on these policies for each of the businesses that we would always analyze. Out of the policies that we've read or we have reviewed, we need to identify the salient points of their policies. And we need to see how these policies are actually implemented by the firm. Because in most cases, what is written in the accounting manual may be different from the actual interpretation or implementation of the policies by the accounting department. Step number two, assess the accounting policies. So when we're assessing the accounting policies, we're looking at the quality of the policies in terms of the management's flexibility in measuring key performance indicators and the risks. How flexible is the management in choosing accounting policies and estimates? Meaning, are they lenient in saying that a KPI has been achieved, or are they lenient in identifying the risks that surround their business? In terms of choosing accounting policies and estimates, we need to ask, among the available acceptable options in terms of accounting for a specific line item, how flexible is the management in choosing what is accepted and available for use? Can they just easily switch from one policy to another? Or are they pretty consistent with what they are doing? Step number 3. You evaluate the accounting strategy. So, as mentioned in the previous video, I have said that accounting or the management has the option to choose the accounting policies, procedures, and estimates. Because there are choices that should be made, we as accountants and as part of the management are actually able to influence the accounting quality or the accounting data that is being generated through the decisions that we have made. Because choices have been made by codifying the accounting strategy or the accounting policies rather, you now start developing an accounting strategy. Why so, miss? Because for each of the choice that we make, there is a corresponding result. And that particular result should align theoretically with the goals that is established or that have been established by the company. So your accounting policies should also be able to match the strategy being established. If the accounting policies and procedures are the manual and the key to understanding the contents of the financial statement, the accounting strategy tells us of the step-by-step procedure. So, because we have chosen X, Y, and Z, what does this achieve in terms of financial reporting? So, we need to ask when evaluating the accounting strategy, how is the firm's accounting policy compared to the norms of the industry? Is it similar to its competitors or is it different? If it's different, is it because the firm's strategy is unique compared to its competitors? Could be. If, say, for example, a company has established a higher warranty allowance than the industry average, it's not common. But one explanation that we can have for this is that the firm competes on the basis of high quality and has invested considerable resources to reduce the rate of product failure. Another reason why a company reports a lower warranty allowance is that the firm has minimal or have merely any understanding of its warranty liabilities. So it could be one or the other. So we need to ask as analysts, is this normal? If this isn't normal, what's standing out? What could be the possible reason for this drastic change? Next, Do managers have strong incentives to use accounting discretion to manage earnings? So this is actually connected to some of the reasons why management is incentivized to manipulate accounting data through accounting policies. Because we can or we may use accounting policies and estimates to our advantage. So as an example, earlier in the previous lesson, we said that if the business does not want to break an accounting-based debt covenant and avoid penalties, then they may be incentivized to actually use that accounting discretion. Another example is that a firm is having, or the managers of a firm is difficulty in meeting accounting-based bonus targets. So if the management is having difficulty in meeting these bonus targets, then it's highly likely that they won't be receiving the bonus. But because they are employees and they are not immune to personal interests, they might be incentivized to use their accounting discretion so that on paper they are able to meet these bonus targets so that they can receive additional compensation. Third, did the firm change any of its accounting policies or estimates? If they did, what was the justification for the change? In accounting, it's not uncommon that a company changes its accounting policies and accounting estimates, given that there is an eloquent explanation as to why the changes were made. So it's not only that the accountants have to explain it eloquently, but the reason for the change has to also be valid and justifiable. So this is all in pursuit of faithful representation and reliability of financial data. All right. Here's more questions usually being asked in step 3. Were the firm's accounting policies and estimates reasonable in the past? So if they did change their accounting policies, were the previous policies and estimates instituted reasonable? And does the firm structure have any significant business transaction so that it can achieve certain accounting objectives? So you would take a look at the one-off transactions with either the parent or the subsidiary or any other related party, because they might use these one-off transactions just so they can achieve a certain accounting objective. All right? In step number 4, after we have evaluated the accounting policies and evaluated the accounting strategy, we also ask about the quality of the disclosures. In accounting, the disclosures are a major part of the financial statements that could be found in the notes. This is why these notes are very important in the sense that they provide greater understanding and guidance to any of the users of the financial statements. So if the accounting policy is the manual, the disclosure actually tells us, or it's the demonstration of what actually happened during the year. So we ask, does the company provide adequate disclosures that allow users to assess the firm's business strategy? So, what does this mean? In accounting, the standards are actually there so that accounting information and the accounting reports are comparable and are organized in the same manner. In this regard, the standards are also prescribing the minimum items that need to be shown on the face of the financial statements and the instances where and when additional disclosures are to be made, aside from the ones that are required. So if there are disclosures, are these disclosures enough to allow users to form judgment on the business, on the business's strategy? Is it enough for the users to base on and conclude that the business is doing poorly or if the business is doing very well? Second, do the notes adequately explain key accounting procedures and assumptions and their logic? So the disclosures should not just be able to tell a story of what happened during the year, but they should also be able to explain the accounting procedures and assumptions applied by those in charge of preparing the financial statements. And above all of this, we need to ask, are these policies, procedures, estimates, and assumptions logical? Number 4, does the firm adequately explain its current performance? So, the income statement and the balance sheet actually tells us of the financial performance and the financial position of the company. Aside from this, the notes should actually dictate and explain further why the numbers were this and that. So they should be able to explain the current performance of the year, and they should be able to highlight the things that happened, especially the unusual ones. Next, if the accounting rules and conventions restrict the firm from measuring its key success factors appropriately, does the firm provide adequate disclosures to assist the users in understanding these factors? So, if we are pretty much set on following the accounting rules, even if said accounting rules do not completely and truly reflect the true nature of the transaction of the business, then is there an adequate explanation that would assist the users in understanding how the firm measures its key success factors and how these factors are being managed? So as you will notice, the notes to financial statements are actually like the recommendations. So they are able to explain the actions of the business. And of course, if there are multiple divisions and business segments, you need to check what is the quality of the disclosure on these other divisions and the business segments. Baka naman, the parent lang ang nagdi-disclose at hindi na nagdi-disclose yung subsidiary or yung ibang division ng parent. More questions here for number 4. How forthcoming is the management with respect to bad news? Does it adequately explain the reasons for poor performance? And does the company clearly articulate its strategy, if any, to address the company's performance problems? So, in accounting, in pursuit of faithful representation and reliability of information, accountants are expected to prepare financial statements that are free from error and bias. So with that said, we are expected to also disclose in the financial statements not just the good news, but also the bad news. So, if there's good news, usually we would happily report it because it's good for the company. If there's bad news, do they report it fairly or are they trying to downplay it? Can they adequately explain the reasons why the bad news happened or why the firm performed poorly during a period? And if they did perform poorly, how do they plan to address this problem? Last question. In evaluating the quality of disclosures, we need to ask if the firm has a good investor relations program. Meaning, do they freely provide fact books, fact sheets, and other detailed data on the firm's business performance? And are they open and accessible to analysts in case the analysts would want to ask the business some questions in regards to their current performance? All right, now that we're done evaluating the quality of the disclosure, let's move forward. After you have identified the accounting policies, after you have assessed the accounting policies and the accounting strategy, and question the quality of the disclosures, you are now ready to identify the potential red flags that exist. So, some of the potential red flags are as follows. Unexplained accounting changes, especially when performance is poor. Kasi po, baka may itinatago ang business. Unexplained transactions that boost profit. Again, just like example number 1. Unusual increases to accounts receivables in relation to the increase in sales. Sometimes, the increase in accounts receivable is not anymore reasonable or it's no longer logical in relation to the increase in sales. In an example, it could be that the sales increased by 20%, but your AR increased by 50%. So what happened there? Unusual inventory increases in relation to the increase in sales. So here, we ask if there is a 10% increase in sales, why is there a 30% increase in inventory? Why is there such a big gap? We always ask this because inventory is a sensitive audit item and sales is always questionable to the auditors. Next, an increasing gap between a firm's reported income and cash flows from operations. So net income in relation to cash flows from operations may be due to a large number of non-cash expenses. So you will be able to see it in the cash flow statement. And of course, you need to compare the gap between the firm's reported income and its income for tax purposes. Here, we also see if the firm has a tendency to use financing mechanisms such as research and development partnerships, special purpose entities, and the sale of receivables without recourse. So why do they do that? Do they really need to perform or sell the receivables with recourse? And why are they engaging in activities where they are using special purpose entities? Baka naman gawin nilang pass-through entity lang itong mga special purpose entities for their own motives. Of course, next, large write-offs that are unexpected. So of course, this is a big red flag, as well as the large adjustments when it comes to quarter 4. So, in audit, the best opinion that we can get as a firm is unqualified. So, if the auditor issues a qualified audit opinion, it could be a red flag. So why is that a red flag? Because a qualified opinion means that they are qualifying a certain degree or a certain item in the financial statements. So it's usually called as an except for opinion. So when they issue a qualified opinion, they're basically saying, okay, we feel like this company, or we see here, and we could agree that based on our review, the company here has faithfully represented their financial data for the calendar year, except for this particular aspect. So it means that their confidence is not full in the company, and they're expecting, and they're showing, and they're giving the public rather a hint not to rely fully on the financial statement, because there is an aspect that they feel like is materially misstated. If the company actually changes independent auditors or external auditors without reasons, or with reasons that are not well justified, then it is a red flag. Next is the unexpected increases in contingencies and off-balance sheet transactions. These contingencies should be able to, or should be disclosed in the financial statements, and should explain why they exist. But if there are unexplainable contingencies and transactions that are not reflected in the balance sheet, then it's a big question mark. After identifying the potential red flags, you are ready to clean up the noise and undo the accounting distortion. So, if the accounting analysis suggests that the firm's reported numbers are misleading, the analyst should attempt to restate the reported numbers to reduce the distortion to the extent possible with the help of external information, the cash flow statement, and the notes to FS. So, the analyst in this case need to corroborate the information he gathered externally and gather additional information that would help him clean up the distortions in the financial data and actually state the numbers as they should be. The analyst would also need the cash flow statement. Miss, why do we need the cash flow statement in this case? Because the firm's cash flow statement is the reconciliation of its performance based on accrual accounting and cash accounting. If you would remember, your financial statements are done using the accrual basis except for the cash flow statement, which is using the cash basis of accounting. So if the analyst is unsure of the quality of the firm's accrual accounting, the cash flow statement provides an alternative benchmark for its performance. This is the reason why your cash flow statement is the check and balance against the cash line in the balance sheet. So, that's why kailangang magkatugma ang iyong cash balance ending in your cash flow statement and your cash balance ending in your balance sheet. The cash flow statement can also provide information on how the individual line items in the income statement diverge from the underlying cash flows. So, what do we mean by this? For example, if an analyst is concerned that the firm is aggressively capitalizing certain costs that should have been expensed, the information in the cash flow statement would be able to provide us with a basis to make the necessary adjustments. But miss, how? So, in your balance sheet, definitely you would see an increase in the assets because the costs have been capitalized. In the cash flow statements, as we know, there are three sections: operating, financing, and investing. Of course, if you're capitalizing certain costs, you would then increase the investing activities of your firm, and you would have to disclose which type of investing activities or what kind of investing activities the firm has engaged in over the last year. So if you see that there is a large number here that says capitalize the cost of research and development, but then per accounting standards, R&D costs are expensed outright. So therefore, the R&D costs that cost your assets to shoot up should have been part of the cash flows from operating activities. So if there is a big chunk there in the investing section that should not be there, you can easily trace the amount of adjustment that you need to do because it is shown in aggregate in the cash flow statement. And of course, your notes to financial statement will serve as your guide in undoing the distortions in your financial reports. Because like I said, the notes to FS is actually the key to understanding the whole financial statements. Now, for the last part of this lecture, we go to accounting analysis pitfalls. We have two common accounting analysis pitfalls, and that is number one, the confusion that conservative accounting is not good accounting. So, as accountants, we are told to be conservative. So, as much as possible, let's go with the choice that would cause the least damage to the company. But from the viewpoint of the financial statement users, conservative accounting is just as misleading as aggressive accounting because these are two extremes. Conservative accounting is being too safe when you don't need to be too safe, and aggressive accounting is being too extreme when really in practice you're not aggressive in these activities. So conservative accounting would also give the management opportunities to smooth income, because if you're being conservative, you can actually control the level of income that you're going to report during the period. So you can manipulate the accounting data if you are doing conservative accounting. And investors will eventually figure out which firms are conservative and thus may discount the management's disclosure and communications. So, based on our disclosures in the financial statements, the users will eventually find out and decide that your company is not worth investing because, like I said, the financial statements are a form of communications for the investors. And if so, and if the investors think that the company is being too conservative, then it may create non-reliance on the financial statements. Some people actually confuse good accounting with conservative accounting. Being conservative is being cautious. Good accounting may differ in definition depending on who you ask, but ideally, doing good accounting is adhering to the true nature of the transactions that actually transpire in the firm and presenting this in ways that are not biased or inaccurate or is not clouded by any judgments by management. So good accounting means that you are being conscious and you're being accountable with what you're doing as an accountant. You're staying true, you are staying faithful to the transactions that happen, and you are trying your best to maintain the understandability, the comparability, and the consistency of the accounting policies and procedures used. So that is two different things from actually just being plain cautious. The second pitfall is the fact that not all unusual accounting is questionable. So it's easy to confuse unusual accounting with questionable accounting. While unusual accounting might make a firm's performance difficult to compare with other firms, such an accounting choice rather might be justified if the company's business is also unusual. So, it doesn't mean that a business is not following the common practice of firms in the same industry. It doesn't mean that they are doing something fishy or something shady in their accounting. It may be okay as long as they're able to justify it, and if their business conditions and environment is actually unusual. So, unusual accounting is not always questionable. And we have to think about the fact that all accounting changes in a firm's accounting policies and accruals to earnings, management's motives. So, as established earlier, all accounting changes in a firm's accounting policies and accruals to earnings are driven by the motives of the management. So, it depends. In accounting, we never say yes or no. We always say it depends, because there is no right or wrong answer in accounting. Sometimes what is wrong for a firm is right for another because it is more appropriate in their circumstance. So with that said, we now come to the last slide. What is the value of accounting data and accounting analysis? So research shows that analysts who are able to identify firms with misleading accounting is able to create value for investors. Earnings management is actually eventually uncovered, and the stock price responds negatively to evidence that prior earnings have been inflated through misleading accounting. And in order for us to be able to do this, we must understand the basic features of the financial reports first and the frameworks that govern them. So, this was already established in the previous video. And in any business, we are always reminded that the ultimate goal of doing business is to actually maximize not the profits, but stockholder wealth. And if the analyst is able to uncover anomalies in the accounting for a firm, it actually affects the value of the stock in the firm negatively. And if we stay faithful to the nature and the types of transactions that actually transpire for the firms, and we are proven to be transparent, accountable, and we faithfully represent all our transactions, it actually leads to positive response from investors. And because of this, they are actually able to help the firm grow in terms of not just the stock price, but adding the value of a firm. So, in real life, as was established in Module 1, accounting can make or break a business. That is why accounting data and accounting analysis is vital to any business. And that concludes part 2 of our discussion of the overview of accounting analysis. That's it for me, and I'll see you in the next one. Bye!